Have you ever wondered why, despite the many economic downturns, the housing and stock markets have remained relatively stable? In the grand scheme of the economy, these markets are like colossal ships, sailing unscathed through the tumultuous waves of financial crises. For many, their stability is a mystery, a puzzle that seems impossible to solve. It's as if these markets are immune to the ebbs and flows that other sectors of the economy face. In the face of recessions, depressions, and even global pandemics, the housing and stock markets have demonstrated remarkable resilience. They rebound faster and stronger than other sectors, and in some cases, they even thrive amidst the chaos. It's a phenomenon that leaves many scratching their heads in wonder and perplexity. The common perception is that these markets are invincible, almost bulletproof. But is that really the case? Is there a secret formula, a hidden mechanism that safeguards these markets from collapse? That's what we're here to explore today. In this video, we'll delve into the inner workings of these markets, peeling back the layers to reveal the truth behind their stability. We'll take a journey into the world of finance and economics, challenging the conventional wisdom and unveiling the unseen factors that contribute to the resilience of these markets. We'll look beyond the surface, beyond the headlines and the sensationalist news stories. We'll dig deeper, asking the tough questions and seeking the answers that few dare to find. Because the truth is, there's more to these markets than meets the eye. Their stability is not a product of chance or fate, but rather a result of complex mechanisms, strategic decisions, and yes, even a bit of cunning manipulation. So buckle up and prepare for an enlightening journey. We're about to venture into uncharted territory, exploring the unseen stability of the housing and stock markets. We'll uncover the secrets that the banks don't want you to know, revealing the true nature of these markets and their surprising resilience. Stay with us as we uncover the truth behind the resilience of these markets. The housing market, a pillar of stability, but what keeps it standing? You might be wondering. It's a question that's been asked time and again, especially in these times of economic uncertainty. Let's unravel the mystery. The first factor we need to consider is government policies. Governments worldwide understand the importance of a stable housing market for the overall economy. Therefore, they often implement policies that support this stability. For instance, they may offer tax incentives to encourage home ownership or subsidies to aid the construction of new homes. These policies can help to maintain a steady demand for housing, even in challenging economic times. Next on our list is the law of supply and demand. The housing market, much like any other market, is governed by this fundamental principle. When demand for houses increases and supply can't keep up, prices rise. On the flip side, when there's an abundance of houses but not enough buyers, prices fall. In many parts of the world, there's a constant demand for housing due to population growth and urbanization. This sustained demand helps to keep the market stable. Finally, we mustn't overlook the role of banks. They provide the capital needed for people to buy homes. By setting interest rates and lending criteria, banks can influence the pace of the housing market. If they make borrowing easier, more people can afford to buy homes, which can stimulate the market. Conversely, if they tighten their lending criteria, it can slow the market down. However, banks have a vested interest in a stable housing market. After all, if the market crashes, they stand to lose a lot of money in defaulted loans, so they often act as a balancing force, lending more when the market is sluggish and less when it's overheated. Now, the housing market isn't impervious to crashes, but these factors, government policies, supply and demand, and the role of banks, work in tandem to provide a certain level of resilience. Understanding these factors gives us insight into the market's seeming invincibility. And that, my friends, is the secret of the housing market's stability. Just like the housing market, the stock market also has its shield. But what is it? Let's dive into this. The stock market, like any other market, is governed by certain principles and mechanisms. These mechanisms are in place to ensure its stability, even when the economic seas get rough. Firstly, we have the principle of supply and demand. This economic theory is the backbone of any market, including the stock market. Simply put, if more people want a stock, its price goes up. If fewer people want it, the price goes down. This dance between supply and demand creates a market equilibrium, a balance that keeps the market steady. Next, we have government intervention. Governments around the world often step in when the market is in turmoil. They can inject money into the economy, lower interest rates, or even buy stocks to stabilize the market. This intervention acts as a safety net, preventing the market from free-falling during economic downturns. Finally, we have market regulations. These are rules set up by financial regulatory bodies to ensure fair play in the market. Regulations prevent market manipulation, fraud, and other unethical practices that could destabilize the market. They are like the referees in a football match, keeping the game fair and orderly. Together, these mechanisms work like a shield, protecting the stock market from undue fluctuations and crashes. They act like the brakes in a car, slowing things down when they start to move too fast, or the pillars of a building, holding it up even when the winds of economic uncertainty blow. Understanding these mechanisms is crucial for any investor. It helps them navigate the market with more confidence and make more informed decisions. It's like knowing the rules of the road before you start driving. So the next time you hear someone predicting a market crash, remember the shield. Remember the principles of supply and demand, the potential for government intervention, and the role of market regulations. These mechanisms, though complex, ensure the market's stability even in the face of economic turmoil. Banks, the silent puppeteers, but how do they pull the strings? Let's unravel this mystery. At their core, banks are financial intermediaries. They stand between savers, who deposit money, and borrowers, who take out loans. This fundamental function of banks plays a key role in the stability of both the housing and stock markets. Firstly, consider lending practices. Banks scrutinize the creditworthiness of borrowers, ensuring that loans are only granted to those who can afford to repay them. This careful evaluation helps to prevent the kind of reckless lending that can lead to market crashes. In the housing market, for instance, banks' stringent lending standards ensure that home buyers can afford their mortgages, preventing defaults and maintaining market stability. Interest rates are another powerful tool in the bank's arsenal. By adjusting these rates, banks can influence the cost of borrowing. When interest rates are low, it's cheaper to borrow money, which stimulates investment in both housing and stocks. Conversely, when rates are high, borrowing becomes more expensive, cooling off these markets. So through their control of interest rates, banks can help to prevent the overheating of markets that can lead to crashes. Finally, let's not overlook the importance of regulatory compliance. Banks are subject to a multitude of regulations designed to ensure their stability and the safety of their customers' deposits. These regulations also play a pivotal role in preventing market crashes. They require banks to hold sufficient capital to cover potential losses and to follow risk management practices that limit their exposure to risky investments. This regulatory framework helps to ensure that banks remain stable even in times of market turbulence, contributing to the overall stability of our housing and stock markets. The role of banks, therefore, is not just about holding and lending money, it's about maintaining a delicate balance, a balance that keeps our markets stable and our economies healthy. From their lending practices to their control of interest rates and regulatory compliance, banks are the silent puppeteers pulling the strings of market stability. Banks, therefore, play a significant part in the stability of our housing and stock markets. So, what have we learned from this exploration of market stability? We've delved deep into the unseen forces that keep the housing and stock markets afloat, defying the predictions of impending crashes. Let's take a moment to reflect on the key points from our journey. Firstly, we discovered the hidden strength of the housing market. Despite the naysayers, the housing market has proven itself to be more resilient than we often give it credit for. The reasons? A combination of steady demand, limited supply, and the continuous inflow of foreign investments. These factors work in concert to keep the market buoyant, even in the face of economic turbulence. Then, we turned our gaze to the stock market. We learned that it's not just about the numbers on the ticker tape. It's about the underlying companies and their performance, their innovation, and their ability to adapt to changing circumstances. Moreover, we uncovered the importance of market sentiment and how investor confidence can be a powerful shield against market downturns. But neither the housing market nor the stock market exist in isolation. They're part of a larger financial ecosystem, with the banks playing a pivotal role. We learned that banks have a vested interest in keeping these markets stable. They do this through their lending practices, their investment strategies, and their role as a buffer against economic shocks. So, in essence, the stability of these markets is not a fluke or a happy accident. It's a result of complex, interrelated factors that are constantly at play. It's about supply and demand, investor confidence, and the strategic role of banks. And why does all of this matter? Because as investors and homeowners, understanding these dynamics can give us an edge. It can empower us to make informed decisions, to navigate the markets with greater confidence, and to protect our investments in uncertain times. Remember, understanding these dynamics can empower us as investors and homeowners. Until next time, keep questioning and keep learning.